Welcome to a deep dive crafted just for you. We're stepping into a feeling many of us know all too well, that underlying fear about market volatility.
It's that knot in your stomach, isn't it?
Yeah.
The worry that the money you've worked hard for, invested, could suddenly just, well, plummet.
Absolutely. And our sources use this really powerful image. Imagine putting all your savings onto like a single spoon. It's precarious, one tremor, one little slip, and the whole thing could be lost. It really highlights that intense risk of having everything tied up in just one place.
It's a very vivid picture of concentration risk.
Yeah.
And it immediately brings us to the core principle this deep dive is built on, drawn directly from your sources: diversification.
Ah, the classic.
It's the reason behind that classic piece of advice we've all heard. Don't put all your eggs in one basket.
So this deep dive is tailored specifically for you, taking the articles, the research, the notes you've shared, and really unpacking the power and the practical steps of diversification. Our mission here, to show you how this strategy can act like that sturdy basket, helping to protect your investments, smooth out those, nerve-wracking market swings,
Those ups and downs.
and position you for potentially more stable, long-term growth. Okay, so let's start simple. What is diversification at its most fundamental level, based on what these sources are telling us?
Well, at its simplest, diversification is really just about spreading your investments around.
Okay.
Instead of concentrating everything in one company or one industry or even just one type of asset, you intentionally invest across different areas.
So the goal isn't some mythical world of zero risk then, because let's be clear, no investment is entirely risk-free.
Right, exactly. No, the sources are very clear on this point. Diversification isn't about eliminating risk altogether. It's about effectively managing it.
Managing it, okay.
It's about reducing the impact on your overall portfolio if, any single investment or a specific sector runs into trouble.
It makes me think of that chef analogy one of the sources used. A meal with just one main ingredient, say, only potatoes.
Right.
If the potatoes are bad, the whole meal is kind of ruined. But a meal with lots of ingredients.
Yeah.
Even if one isn't quite perfect, the other flavors, the textures, they can compensate, making the overall dish much better, kind of smoothing out those imperfections.
That's a great way to visualize it. And the underlying theory, which is confirmed across these sources, is that a portfolio built with different assets, particularly assets that don't always move in lockstep with each other, that aren't perfectly correlated.
Okay.
It tends to achieve higher long-term returns with lower overall risk compared to focusing heavily on just one or two things. The different parts act like shock absorbers for each other.
Got it. So how do we actually do this? What are the key dimensions of diversification the sources highlight?
Well, the most fundamental layer, and one the sources spend quite a bit of time on, is diversifying across asset classes.
Asset classes.
Yes. This is really foundational because different types of investments react very differently to the same market or economic conditions.
Like the core categories mentioned. Stocks, bonds, real estate cash, that kind of thing.
Precisely. Stocks, or equities as they're often called, are generally the engine for growth in a portfolio.
Right. Higher potential return.
Higher potential, but also higher volatility, more ups and downs. They generally perform best when the economy is looking strong.
And bonds, the fixed income side, what role do they play?
Bonds typically offer more stability and generate income. They can act as a really crucial buffer, often performing better during economic downturns when stocks might be struggling.
Okay, buffer.
Though it's important to remember, as your sources definitely point out, that rising interest rates can actually cause the prices of existing bonds to fall. That's a key risk there.
Right, that inverse relationship. Real estate also gets a mention for both potential appreciation and rental income, and it's often seen as a hedge against inflation.
Absolutely, whether it's through owning property directly or using something like a REIT that's a real estate investment trust.
Okay.
Which is basically a company owning income-producing real estate. It gives you exposure to physical assets with a different risk profile.
And cash, or cash equivalents.
Yeah, things like treasury bills or CDs, primarily for liquidity and safety. Money you might need soon or want to keep very safe, even if they offer minimal growth. And it's worth noting, as one source specifies, standard money market funds aren't FDIC insured like bank deposits unless they are specifically structured as a certificate of deposit, a CD.
Okay, good distinction. So combining these different asset classes helps a portfolio weather different economic climates. Is that the idea?
That's exactly it. What hurts one asset class might actually benefit, or at least not harm another. Rising rates might make bonds less attractive initially,
Right.
but could maybe support real estate values through rental growth or influence commodity prices differently. They don't all move together.
Okay, that makes sense. That's diversifying across the big buckets. What about diversifying within those buckets? The sources talk about diversifying within asset classes, like across different sectors and industries.
Yes, this is another crucial layer. Let's say you decide stocks are right for you. If you put all your stock money into, say, only technology companies,
Uh-oh.
you're really exposed if the tech sector hits a rough patch. So you need to spread that stock exposure across different sectors. Think healthcare, energy, consumer goods, finance, industrials, and so on.
So if a specific industry faces unique challenges, maybe, I don't know, new regulations or a big shift in consumer taste, your whole stock portfolio isn't dragged down with it.
Exactly right. And the sources provided a really fascinating specific example here, looking at hedging risk related to, believe it or not, potential future pandemics.
Oh, interesting.
They highlighted the idea of holding investments in airlines, which tend to do better with fewer shutdowns and travel restrictions,
Makes sense.
alongside investments in, say, digital streaming platforms, which actually benefited from more shutdowns as people stayed home.
Ah, so they counterbalance each other based on that specific risk factor.
Precisely. It's a clear illustration of offsetting specific industry risks.
That example really makes it concrete. Okay, moving on. The sources also emphasize dimension 3, geographically, investing globally.
Right. Different countries and regions often have different economic cycles, different market drivers.
Yeah.
Relying only on, say, the U.S. economy means you're fully exposed if the U.S. faces a downturn.
So investing globally reduces that single economy risk.
It does. You gain exposure to potential high growth in emerging markets, although the sources do remind us that often comes with higher risk.
Yeah, they mentioned Pakistan being reclassified from emerging to a frontier market, signaling maybe increased risk perception there.
Exactly. But you also gain exposure to the stability, potentially, of developed markets outside your home country. The sources specifically mention holding Japanese stocks as a potential cushion against a U.S. economic downturn, again showing how different economies can provide that vital, uncorrelated, or maybe even negatively correlated movement.
Got it. Dimension 4 feels a little different, more about timing, dollar cost averaging.
Yeah, this strategy is incredibly practical, especially for you if you're just starting out or building up your investments over time. Instead of trying the, frankly, impossible task of timing the market perfectly with one big lump sum,
Which nobody can do consistently.
right, you invest a fixed amount of money regularly, say $100 every single month, regardless of what the market prices are doing.
Okay, so by doing that, you're automatically buying fewer shares when prices are high.
Mm-hmm.
But you get more shares when prices are low.
Precisely. Over time, this averages out your purchase price per share. It takes away the stress of trying to guess market tops and bottoms.
Yeah, less stressful.
And importantly, it ensures you consistently participate in the market's potential growth over the long haul. The sources really highlight this as an accessible and inexpensive way for individual investors to build diversified positions, especially using things like broad ETFs.
Diving a bit deeper into the sources, they bring up some additional, maybe less obvious dimensions and strategies for diversification, like diversifying based on corporate life cycle stages.
Yes. Think about the difference between growth stocks and value stocks.
Okay.
Growth companies are typically newer or expanding rapidly, expected to grow their revenue and earnings faster than the average company. They offer high potential but are often higher risk.
Right.
And can be particularly sensitive to changes in things like interest rates, monetary policy.
And value stocks.
Value stocks, on the other hand, are often more established, stable companies that the market might be undervaluing relative to their fundamental worth, like their assets or earnings. They're generally considered more stable, maybe less risky than growth stocks.
And combining them lets you capture different aspects of the market, sort of future potential and existing stability.
Exactly. It's another way to spread risk. Another angle is market capitalization, basically, the size of the company.
Large cap versus small cap.
Right. The sources contrast large cap companies, think massive established players like Apple, relatively stable, maybe less room for explosive growth, against small cap companies like Newell Brands was mentioned, smaller, potentially riskier, but maybe with much more room for significant growth ahead. Their operations, their capital needs, even how they approach product development are just fundamentally different, offering another layer of diversification.
And the sources mentioned diversifying by risk profiles, even within an asset class. That sounds interesting.
Absolutely. Take bonds, for example. Not all bonds are created equal risk-wise. You have high-yield bonds, sometimes called junk bonds,
Right.
that carry more default risk but offer higher potential returns versus high-quality government bonds with much lower risk but also lower yield, or even in the crypto world. Bitcoin, while certainly volatile, is often seen by some as lower risk relative to much smaller, newer cryptocurrencies. The sources use that extreme YOLO strategy, putting everything into one highly speculative asset as the stark opposite example.
Yeah, the anti-diversification strategy.
To highlight the kind of risk diversification aims to mitigate.
Maturity lengths for fixed income is another point raised.
Yes, specifically for bonds or maybe even leases. In bonds, longer maturity bonds, ones that pay back further in the future, typically expose you to more interest rate risk.
Meaning their price swings more when rates change.
Exactly. But they might offer higher yields to compensate. Shorter maturity bonds are less sensitive to rate changes, but usually offer lower yields.
And the sources drew a parallel to real estate leases.
Yeah, kind of comparing short-term residential leases, which offer you flexibility but less guaranteed income security, versus long-term commercial leases, which offer more income security but sacrifice that flexibility. Different risks, different benefits again.
And finally, tangibility. The difference between intangible assets like stocks and bonds versus tangible assets, things you can touch, like land, real estate, commodities, precious metals.
This is a really key distinction the sources make. Tangible assets have a physical form. Real-world uses, maybe consumption, generating rent, potential development.
Right.
But they also come with unique risks that intangible assets don't face in the same way. Things like vandalism, theft, the actual costs and risks of storing them, insuring them against physical damage like fire or flood. The sources compare holding physical gold, for instance, versus a gold ETF exchange-traded fund. Physical gold exposes you to storage and theft risk. A gold ETF exposes you to different risks like technological glitches, counterparty risk, who's holding the gold, or custody issues.
So you can diversify against different types of risk by holding both tangible and intangible forms of an asset, potentially.
Potentially, yes. It adds another dimension to consider.
Wow. Okay, the sources even bring up diversifying across platforms. This adds a layer of risk that's less about the investment itself and more about where you actually hold it.
This is a really important, very modern point the sources highlight. Think about it simply like this. Holding all your cash savings at one single bank versus spreading it across a few different banks.
Okay.
Or even keeping some cash safely at home. Different risks apply, right? It's got FDIC insurance limits per institution, the, albeit unlikely, risk of a bank run affecting one bank, or the physical risks of theft or fire if you keep cash at home.
And applying this to the crypto space, that Celsius Network bankruptcy is mentioned as a stark example.
Exactly. Investors who held all their cryptocurrency on that single exchange platform suddenly found themselves completely unable to access their assets when the platform collapsed.
Yeah, a nightmare scenario.
It really was. The sources use this to underscore that diversifying where your assets are held, maybe across different brokerage accounts, different crypto exchanges, or even different types of storage methods like hardware wallets, adds another valuable layer of protection against specific platform failures or custodial risks.
Wow. Okay, there's certainly more layers to this diversification thing than just basic stocks and bonds. So, pulling all these different dimensions and strategies together, why does diversification really matter? What are the big picture benefits according to the sources?
Well, the overwhelming takeaway, the consistent message across all the sources, is that diversification is arguably the single most powerful tool you have for mitigating portfolio risk, specifically what's called unsystematic risk.
Unsystematic risk.
Fundamentally, it reduces the overall risk level of your entire portfolio.
And it helps hedge against that market volatility, working to smooth out those ups and downs you mentioned earlier.
Yeah.
Making the ride less bumpy.
Yes, which, over the long term, increases the potential for achieving more stable, more consistent returns. It significantly lessens the potential damage to your overall wealth if one single negative event hits, like one company failing, one sector crashing, or one country's economy tanking.
And frankly, for some people, maybe learning about and exploring these different dimensions, different markets, different asset types can just make the whole process of investing feel more interesting and maybe less intimidating.
Absolutely. That's a potential side benefit. And statistically speaking, it also increases the chance that some part of your portfolio will be positively impacted by any given piece of good news out there in the market somewhere. You're not relying on just one thing to go right.
You brought up unsystematic risk just now. The sources draw a pretty clear line between the risks you can diversify away and the risks that are just sort of part of being invested in the market overall.
That's right. They distinguish between systematic risk and unsystematic risk. Systematic risk is market-wide risk. It's macro. It impacts almost the entire market or the whole economy.
Like the pandemic example.
Exactly. Think about the initial shock of the COVID-19 pandemic. It impacted businesses globally, caused widespread layoffs, changed consumer spending habits dramatically. Then you had broad government stimulus measures that affected the entire economy. Diversification can't eliminate this kind of risk because it affects almost everything, more or less together.
But unsystematic risk is the one diversification specifically targets.
Precisely. This risk is specific to an individual company, a single asset, or maybe a very narrow industry. The sources detail examples like business risk, just inherent to what a particular company does, financial risk, maybe a company's high debt levels or cash flow problems, operational risk, problem with production lines or internal processes breaking down, or regulatory risk.
Like new laws affecting just one sector.
Exactly. The sources mention the CHIPS Act as an example. Legislation primarily aimed at boosting semiconductor manufacturing in the U.S. That has a huge direct impact on semiconductor companies, but not nearly the same direct impact on, say, the financial services sector.
So diversification is designed specifically to protect you from the fallout if one of your specific holdings suffers from one of these unique diversifiable misfortunes.
That's the core idea. It reduces your exposure to the bad luck or specific problems of any single investment you hold.
Okay, this is all making sense conceptually, but how do we even begin to measure how diversified a portfolio actually is? It sounds incredibly complex to quantify perfectly.
It is complex, yeah. And the sources are quite upfront that there's no single perfect, easy measure, but there are definitely methods used to get a good sense of it.
Like the correlation coefficient that was mentioned.
Yes. That measures how two different assets tend to move in relation to each other. It's on a scale from -1 to +1.
Okay.
Ideally, for diversification, what you're looking for is assets that move in the opposite direction. That would be a correlation closer to materials, or at least assets that don't always move together, a correlation closer to 0. That's where you get the real risk reduction benefit.
Because if they have a high positive correlation, closer to +1.
Then those assets are likely to rise and fall around the same time, which means they offer much less diversification benefit to each other. They're kind of moving as a pack.
Got it. Standard deviation was another measuring volatility.
Right. Standard deviation measures how much an asset's return tends to fluctuate around its average return. A portfolio made up entirely of assets that all have high standard deviations might individually have high potential returns. But they're also all more likely to experience similar types of large price swings, making the overall portfolio potentially less stable than one that includes a mix of assets with different volatility profiles or, importantly, low correlations to each other.
Okay. Smart beta strategies were also brought up briefly.
Yeah, those are a bit more advanced. They're strategies that generally track market indexes but use different rules than just market size or market cap to choose or weight the stocks they hold. Often they use fundamental factors like value or low volatility, aiming to achieve a slightly different risk-return profile than you'd get from a pure market index fund.
And then there are simpler methods like just counting or looking at the weights.
Absolutely. For most people, the most accessible methods are simply looking at the numbers. How many different individual stocks or bonds do you actually own? What percentage of your total portfolio is allocated to different asset classes? Like, are you 60% in stocks and 40% in bonds?
Or within stocks, how much is in just one industry?
Exactly. What percentage of your stock holdings are concentrated in just one or two industries, like technology or energy? Is it 75%? That might be too concentrated. The sources reference studies looking for an optimal number of stocks,
Right.
noting there's no single magic number, but often mentioning that adding more than, say, 25 or 30 individual stocks tends to offer diminishing returns in terms of further risk reduction benefits. You get most of the benefit by them.
Okay. So for someone listening who wants to take action based on all this, especially if they're relatively new to investing, what are the practical steps the sources guide us towards?
Well, the really great news is that achieving significant diversification is much, much easier and more affordable today than it used to be, thanks largely to online brokerage platforms and modern investment products like ETFs.
So where's the best place to start?
The absolute best starting point the sources consistently recommend, especially for beginners, are broad market exchange traded funds, ETFs, or traditional mutual funds.
Because they offer that instant diversification right out of the box.
Exactly. Investing in a single S&P 500 index fund, for example, immediately gives you ownership slices of 500 of the largest U.S. companies across all the major sectors.
Wow. Yeah.
It's an incredibly inexpensive way to get really broad exposure, instantly diversifying you across hundreds of companies and multiple industries. It totally overcomes the old hurdles of cost and the difficulty of tracking maybe dozens of individual stocks or bonds, especially for a retail investor.
And you can even get funds that cover international markets or commodities.
Absolutely. There are ETFs and mutual funds now that offer easy access to international stocks, bonds, commodities, real estate areas that might be difficult or expensive for an individual investor to access directly.
Target date funds sound really helpful too, particularly for people saving for retirement.
They are excellent options, especially within retirement plans like 401ks or IRAs. These funds automatically adjust their asset allocation, that mix of stocks, bonds, cash, etc., over time.
Oh, so?
They generally start out more aggressive, more stocks when you're young, and gradually become more conservative, more bonds, as you get closer to your target retirement date. They basically provide age-appropriate diversification on autopilot.
That's very convenient. And once you have a diversified portfolio set up, the sources really stress the importance of rebalancing it periodically. Why is that necessary?
It's crucial because, over time, different parts of your portfolio will grow at different rates. Your stock allocation might soar while your bonds lag, or vice versa. This throws your carefully chosen percentage mix, maybe that 60-40 stocks to bonds target, out of whack.
So rebalancing brings it back into line.
Exactly. Rebalancing, maybe done once a year or when the allocations drift too far, involves selling some of the assets that have grown to become a larger percentage of your portfolio than intended,
Okay.
and using those proceeds to buy more of the assets that have lagged or shrunk as a percentage. It brings you back to your original target allocation.
And it forces you to systematically buy low and sell high in a disciplined way.
That's a key benefit. Yes, it imposes discipline.
And finally, perhaps most importantly, the sources emphasize understanding your own personal risk tolerance and your investment time horizon.
This is absolutely fundamental. Your personal right mix of assets, how much in stocks versus bonds versus other things, depends entirely on your age, your specific financial goals, and, crucially, how comfortable you are psychologically with seeing the value of your investments go down in the short term.
So younger investors can generally handle more stock risk.
Typically, yes. Younger investors with decades until they need the money can usually afford to take on more stock exposure, aiming for higher long-term growth potential because they have more time to recover from any market downturns.
Whereas older investors?
Older investors who are closer to needing their funds for retirement or other goals might lean more towards the relative stability and income provided by bonds and cash equivalents.
The sources illustrate this by talking about how you'd adjust your allocation as retirement gets closer, maybe shifting from mostly stocks when you're 25 years away to a more balanced portfolio 10 years away.
Precisely. You gradually de-risk as the time horizon shortens, but importantly, even in retirement, most people still need some exposure to growth assets like stocks.
Why is that?
To combat inflation, which erodes the purchasing power of your money over time, and also to reduce the risk of outliving your assets during what could be a long retirement. But the key takeaway is, regardless of your specific age or risk tolerance, having some allocation to fixed income to bonds can generally help reduce the overall volatility of your portfolio compared to being 100% in stocks.
Okay, that makes a lot of sense. Let's quickly recap the pros and cons of diversification that we've touched on throughout this discussion.
Sure. On the pro side, drawing from everything we've covered based on the sources, Diversification clearly reduces overall portfolio risk, especially that unsystematic risk. It hedges against market volatility, smoothing the ride. It increases the potential for more stable, consistent long-term returns. It significantly reduces the impact if one single investment goes bad. It can make investing more engaging or interesting. And it improves the statistical chance that some part of your portfolio will benefit from positive news somewhere in the market.
Okay, those are compelling benefits. And the cons? What's the downside?
Well, the main trade-off, and the sources are very clear about this, is that diversification, by its very nature, limits your potential for those massive short-term windfall gains from picking one big winner.
Ah, right. The example given was putting $120,000 into one stock that then doubles, you have $240,000.
Exactly. But if you spread that same $120,000 across 6 different diversified assets, and only one of those assets happens to double while the others stay flat or do okay.
Your total gain is much smaller than in the concentrated single stock scenario.
Much smaller, yes. You sacrifice the chance of hitting that massive home run with one specific bet.
In exchange for reducing the risk of striking out completely if that one bet goes wrong.
Precisely. That's a fundamental trade-off. Other perceived cons, maybe less significant today, could be that managing many different investments feels more time-consuming or overwhelming for some. And historically, it often meant incurring more transaction fees from buying and selling lots of different things, although that's much less of an issue now with low-cost online platforms and ETFs. But yes, that limitation on chasing maximum short-term gain is the direct price you pay, essentially, for gaining long-term stability and reduced risk.
Okay, so to bring this deep dive toward a close.
Diversification, at the end of the day, isn't about finding some magic way to eliminate all market uncertainty or guarantee returns, but it is an incredibly powerful, time-tested, and well-proven strategy for managing risk effectively. It's fundamentally built on that core principle of not having everything riding on one single outcome.
It really seems like the fundamental way to build a portfolio that's better equipped to navigate inevitable economic shifts and market turbulence, aiming to smooth out that volatility and significantly improve your probability of achieving your long-term financial growth goals.
Exactly. It provides you with the essential tools to balance that necessary pursuit of investment returns with the equally crucial need to protect your hard-earned capital. Ultimately, it aims to reduce those really uncomfortable, stomach-churning ups and downs you might otherwise face if you're too concentrated.
And applying this knowledge, all drawn from the sources you've provided us with, seems like a critical step for your financial journey, whether you're just starting to invest or perhaps reevaluating your current approach. So let's leave you with this final thought to mull over, really pulling from some of the nuances we explored in the sources today. Given that diversification, by design, deliberately limits your potential for those massive, fast windfall gains in exchange for seeking long-term stability and risk reduction.
That core trade-off.
And acknowledging that even the sophisticated methods of measuring the optimal level of diversification are complex and still debated among experts. How does truly understanding this fundamental trade-off influence your personal investment goals, shape your comfort level with different types of financial risk, and perhaps guide how you might choose to adjust your own investment strategy as your life circumstances and your time horizon inevitably change over the years? Something to consider as you move forward.